Singapore's Straits Times Index saw one of its biggest intraday declines of 8.6% on Monday. Banking stocks were among the biggest losers, and the index ended down by 7.4% at the close of trade. Caitlin Ng with this report.
The Straits Times Index was mostly in the red in Monday's trade. This amid the reciprocal tariffs imposed by the Trump administration, which are set to take effect this week.
There is no doubt that this is a very significant blow to the STI. It needs to be put into context of the fact that the STI, or Singapore, is a very trade-dependent economy, and the market is viewing the Trump tariffs with a great deal of trepidation, especially in terms of its potential impact on a trade-dependent economy such as Singapore.
The STI tracks the performance of the top 30 companies listed on the Singapore Exchange and is viewed as the market barometer. Monday's decline is the biggest since the 8.9% sell-off during the global financial crisis on the 24th of October in 2008. It also exceeded the 8.4% crash on the 23rd of March in 2020 during the COVID-19 pandemic. One market watcher says investors were spooked by news of the US tariffs.
When bad news happen, we tend to see more panic selling. Yes, I mean, of course, this kind of so-called massive impact on trade war definitely affect economy, due to all these high tariff. But again, magnitude of this impact is really yet to be determined. I mean, the thing is, investors don't really like uncertainty. So given the unknown in the near future, many prefer to stay on the sideline, which leads to massive sell-off.
Mr. Quay adds that Singapore investors need to keep a close tab on global shifts in other financial markets like Europe and China, as these could affect how the local market moves. Other market observers also advise investors to look beyond the news flow and to also diversify and balance their portfolios.